Yo, what's good? My name's Kang, and in this video, I'm going to be going over possibly one of the biggest finesses in personal finance, mutual funds. Now, I know this topic can be a bit controversial, so let me know what you think down in the comments below. And while you're down there, hit the like button because it really helps the channel grow. So let's be real for a second. Personal finance and investing are both tough, and in my opinion, simplicity is key. And to illustrate that, let's paint a little scenario. So, you know you need to invest money, but you don't know how and you don't want to learn how, which is completely fair. But you hear about this thing called a mutual fund, where basically you just give your money to a professional or a team of professionals and they will take your money and invest it into the stock market for you in exchange for a fee. And you're probably thinking to yourself, wow, this sounds like a great deal. Like, these guys are pros, they're probably gonna do way better than I would do if I were to learn how to do it myself. And these mutual funds promise low risk, high reward, and the ability to beat whatever benchmark that they're facing off against, which in most cases is the S&P 500. Seems like a great idea, no? Well, unfortunately, most of the time it's not, and you're much better off investing your own money. Let me explain why. Before I explain why mutual funds kind of suck, let me first give some more background information on mutual funds. Mutual funds come in all different shapes and sizes with different risk levels, investment goals, strategies, target countries, sectors, you name it. Most of the time, they offer what seems to be low risk, high reward, diversified solutions that are very easy to use. Mutual funds are a very popular investment vehicle for Canadians. According to this 2020 paper by IFIC, mutual funds held $1.6 trillion worth of assets, whereas ETFs only held $234 billion. And this makes sense because these mutual funds are very commonly offered by banks, which makes it very easy for Canadians to get roped into. Just imagine, you're calling about a weird credit card charge, and the next minute someone's whispering into your ear talking all this nonsense about safe returns and risk adjusted and handled by pros, and then boom, you're in a mutual fund. And mutual funds make it very easy to invest. A lot of the times they'll take the money right out of your account, and then you're left with this sense of security that your investments are being handled by the pros. But wait, Kang, this all sounds actually really great. You're telling me I have a team of pros that are working for me. It's very easy to use. They're somewhat diversified, low risk, high reward. Like, I don't see the issue here. Where's the finesse? Well, there are two big reasons. Reason number one, mutual funds have very high fees. These fees fall within the range of 1 to 3% a year, and the average is somewhere around 2.something%. This fee comes from the fact that mutual funds are actively managed, which means that someone or a team of someone's is deciding when to buy or sell and what to buy and sell and what kind of investment strategies to implement. Now, if you're comparing these mutual fund fees to the fees that you would pay with an ETF that just tracks an index, you're looking at fees that could cost up to 10 times more. But you might say the high fees is a trade-off. These guys are pros. They're going to do way better than an ETF that just tracks an index. No shot I can do better alone. Which brings me to the second reason why mutual funds kind of suck. Most mutual funds cannot consistently beat their benchmark over a long period of time. According to the Spiver article, 86% of all US equity-based mutual funds in the past 20 years have underperformed when compared to their benchmarks. And it's even worse for small cap stocks, with 88% of active fund managers underperforming their benchmark. So on top of the fact that the majority of mutual funds fail to beat their benchmarks, they have the audacity to charge you, the investor, 2.something% a year in fees. And this fee is charged no matter what, even if the mutual fund's returns are negative on the year. I mean, just look at this. Here we have a TD mutual fund with ticker TDB2050. This mutual fund is trying to emulate returns that are better than its benchmark, the Russell 1000. And for those of you who don't know, the Russell 1000 is just another index that's similar to the S&P 500. And if you look at the returns, they're honestly pretty good, only until you compare them to IWB. IWB is an ETF that passively matches the Russell 1000. And if you take a look at the returns of IWB, it has beat the mutual fund every single year for the last 10 years. Oh, and did I mention that the mutual fund has a fee of 0.239% and the ETF has a fee of 0.15%? And maybe you can say that this particular mutual fund just kind of sucks, but I can go on for days looking for examples where mutual funds fail to beat their benchmarks. And you can even do it yourself. Just go look for any mutual fund, look for the benchmark that they're tracking, and then look for an ETF that tracks that benchmark, and then compare the two. Compare the fees and compare the returns. And while there have been mutual funds that have been able to beat the market consistently over a long period of time, what's to say that they will continue to do so? It's easy to look at past returns and say like, yeah, they're just going to do that again. It'll be easy. But past returns do not indicate future performance. So even if you're to take your chances of picking a mutual fund and beating the market, good luck, because there's a lot, and I mean a lot, to choose from. In 2020, the US had over 7,000 mutual funds, and in Canada, there was over 5,000. So good luck picking the winner out of all of those. Okay, and if I can't convince you, take it from Warren Buffett, the GOAT of investing. Back in 2008, Warren Buffett made an open bet of $1 million. basically saying, I challenge any hedge fund to beat my S&P 500 index over the span of 10 years. And a hedge fund called Protege Partners stepped up to the plate. They created 5 different hedge funds and used a bunch of different strategies and a bunch of different smart people to try to beat Warren Buffett's S&P 500 index. And what happened next didn't look too good for Warren Buffett. They started the bet in 2008, and as most of you know, during 2008 there was a huge recession, which caused a lot of the stock prices to plummet. And during this time, the hedge fund was able to move around some assets and sell some investments, and hedge some investments in order to reduce the amount of drawdown on their portfolio. All Warren Buffett was able to do was buy and hold. However, after 2008 and 2009, Warren Buffett's S&P 500 index fund was able to beat all of the hedge funds every single year. And by the end, after 10 years, Warren Buffett's S&P 500 index fund came out ahead by a landslide. The final return of the S&P 500 after 10 years was 125%, whereas the best fund from Protege Partners returned only 87%. This is a really interesting story, so if you want to read more about it, I'll leave some links in the description below. Okay, Kang, you got me convinced. Mutual funds kind of suck, but what are the alternatives? If you're someone that doesn't want to really do a lot of work for their investing in personal finance, mutual funds seem like a really great idea because they do a lot of the work for you. But here's where I want to make some recommendations instead of picking a mutual fund. The first is a robo-advisor like Wealthsimple Invest. These robo-advisors make it very, very easy for you to get started with investing. They do a lot of the work for you and make investing very easy for the average person. On top of that, robo-advisors like Wealthsimple Invest charge much lower fees in comparison to mutual funds. The other recommendation that I have is creating a DIY portfolio through a self-directed brokerage account like Questrade. DIY investing requires a little bit more work than using a robo-advisor or investing with a mutual fund, but it's the lowest in terms of fees by far. Before, you would have to have multiple ETFs and rebalance every so often, but with the emergence of all-in-one funds like XGrow or VGrow, DIY investing has never been this easy. If you like to watch, I have videos comparing DIY investing versus robo-advisors, and I also have videos describing all-in-one funds like XGrow and VGrow. I'll leave them linked down in the description below. Overall though, for the majority of people, I think that they're much better off ditching the mutual fund and going for a low fee, passive style of investing. In the past, when investing was more difficult and there was not that much information for the common person, maybe investing into a mutual fund makes sense. But with the emergence of platforms like Wealthsimple Invest or even all-in-one funds, I find less and less reasons to invest using a mutual fund. Personally, the only time that I would invest into a mutual fund is if it was through an employer-matched RRSP program or an employer-matched 401k program. But if you're still dead set on sticking with some mutual funds, there are actually some good ones. For example, the TDE series are actually a great set of mutual funds. I personally invest my money using all-in-one funds because it's the perfect mix of cost, work, and ease of use. But other than that, thanks for watching the video if you made it this far. If you liked it, please consider liking and subscribing. I plan to make a new video every 2 weeks, so hit the bell notification so you don't miss out. If you have any questions or comments, leave them down below or hit me up on Instagram. But other than that, thanks for watching. I'll see you guys next time. Later.